May jobs report from the Bureau of Labor and Statistics just landed this past Friday, and on the surface, these numbers look like a blockbuster. The U.S. economy added a whopping 172,000 jobs in May, crushing expectations, which were closer to 80,000 jobs expected for the month, and pointing to a labor market that is still running hot. Additionally, both March and April jobs reports were revised upwards by a combined 93,000 jobs. All in, the unemployment rate is still sitting around 4.3% with all of this together. And even the average monthly job growth is up from around 63,000 jobs per month a year ago to nearly 190,000 this spring. So, against a lot of unfavorable odds, the US job market looks very strong. Now, from a macroeconomic perspective, in a consumer driven economy, this is good news on Main Street. And you'd expect Wall Street to also be cheering, especially since corporate earnings growth in the first quarter has been strong. And 85% of S&P 500 companies posted quarterly profits that, quote, exceeded analyst expectations, which is the highest share in almost 5 years. Now, that's all really good economic news. But what actually happened? Both the NASDAQ and the S&P 500 had their worst day of the year on Friday following this news. Not only that, but the bond market tanked, Treasury yields once again shot up, and investors even sold out of gold and Bitcoin on this news. Not only that, the VIX spiked and hit its highest level in April, meaning options trading on the S&P is predicting more volatility in the coming months. Now, to be fair, the VIX consistently overestimates actual future volatility by a pretty significant margin, but the trading activity that it measures is still a useful data point to have. It is important to note that some of the stock losses came from poor performance of AI stocks, specifically from a disappointing earnings report from Broadcom, which sent ripple effects through the AI trade. But the primary catalyst for the drop across multiple asset classes was what this strong jobs data means for one thing: expectations for the Fed to cut rates. Almost any hope for a summer or early fall interest rate cut from the Fed got pretty much tossed out the window. At the beginning of the year, for perspective, markets and a lot of Wall Street analysts were expecting at least one, possibly two rate cuts this year. Today, due both to inflation concerns on rising oil prices because of the continued war in Iran, and now with surprisingly strong employment numbers continuing, rate cuts expectations are at zero. The futures markets, which you can look at through the CME FedWatch tool, are now even looking at the possibility of one or two rate hikes this year. So what on earth is going on? How can fantastic news for American workers be such terrible news for the markets? It is a paradox that highlights economic complexity. Good news for the economy sometimes translates to bad news on the tickers. And we're going to break down what happened. I want to show you the market's pretty violent reaction and explain exactly how a strong jobs report connects to your wallet. To get why the market freaked out, let's dig a little deeper into the numbers that kind of lit this fuse. Last Friday, as we said, June 5th, the Bureau of Labor Statistics released its big jobs report for May. And economists were waiting to see if the job market was finally starting to cool off a little bit, with most predicting a pretty respectable but slower gain of about 80 to 88,000 jobs. What they got instead was pretty stunning. The headline number was that massive 172,000 jobs added in May, more than double the expectation. So this continues a pretty strong streak of job growth. It hasn't been every month, but over the past 12 months, the U.S. economy has added in total around 500,000 jobs as unemployment holds steady. And the strength for May was everywhere too. Healthcare added 35,000 jobs, government added 55,000, leisure and hospitality tacked on another 70. So this wasn't just one industry holding things up. It was a sign of widespread, strong demand for workers across industries. And that's an important point. But the jobs number was only part of the story. The other part that investors and traders paid attention to was wage growth. Average hourly earnings, a number that the Fed watches pretty closely for inflation, grew 0.3% in May and were up 3.4% from a year ago. And both of those figures were actually in line with expectations. But the report did have a bit of a split personality. Number one, as anyone who's looked at their budget lately can tell you, wage growth for a lot of people is lagging behind inflation. Average wage growth might be at 3.4%, but where's inflation? Currently 3.8%. And there were a couple of weaker signals buried in the details that a lot of analysts have now highlighted. The labor force participation rate is one, which is the share of people working or looking for work. That held at just under 62%. And the long term unemployment rate, the share of unemployed workers who have been out of work for 27 weeks, which is almost 7 months or more, rose to 27.5%, which, to give you perspective, is up from 20.4% this time last year. That's a 7% increase, and it is not a good sign. And a really important element of that is the labor turnover is really low right now, meaning people are staying in the jobs they have as opposed to changing careers. So both hiring rates and quit rates are pretty low at the moment. And that lack of momentum within the market usually isn't a good sign because it can suppress things like wage growth and may be a small sign of actually seeing slowing business expansion overall. So we have this very strange picture in front of us in the data. One survey of businesses is showing hiring and rising pay, while another survey of households shows more people are out of work for longer periods of time, which is anecdotally confirmed. If you spend any time on social media, people are sharing stories of a lot of difficult job searches and a lot of long-term unemployment stories, not for lack of trying. But on Wall Street, where the story and the headline is everything, traders seized on the big headline number. The takeaway was loud and clear. The labor market overall is not cooling, and if anything, it might be heating up. And that conclusion is what set off these pretty major red fireworks in the markets. We opened down right at the bell, 9:30 a.m. Eastern, and you could literally watch the financial markets trying to reprice the future of the economy in real time. Stocks got hit hard, but the epicenter of this earthquake was the bond market. So to see what happened, you have to look at one of the most important numbers in finance, which is the yield on 2-year Treasury notes. I've talked a lot recently about the spike above 5% on 30-year treasuries, but a lot of investors look at the 2-year yield as basically the market's fever chart for what the Fed will do next. So, when traders think the Fed is about to cut rates, a lot of times they will buy 2-year notes, pushing their prices up and the yield down. Remember the seesaw: yields go up, prices go down, vice versa. When they think the Fed is going to stay tough, they sell, pushing prices down and the yield up. And on the morning of the report, the 2-year yield saw one of its biggest jumps of the year, spiking by more than 15 basis points. That's 0.15%. Pretty fast. This was a strong move, reflecting a significant change in thinking. Traders were dumping short-term bonds, betting that the Fed, seeing this strong jobs report, now had pretty much no reason to cut interest rates, at least in the near term. And the shockwave did not stop there. The yield on the 10-year U.S. Treasury note, which the benchmark we've talked about, it's the benchmark for everything from mortgage rates to business loans, that also jumped pretty decisively. It climbed higher, signaling that borrowing costs were about to once again get more expensive for everyone. And remember, when bond yields go up, the price of existing bonds goes down. For anyone holding a portfolio of older, lower yielding bonds, the value of their investments took a hit on Friday. And with the very foundation of the market, this risk-free rate of government bonds continuing to shift higher, the pain is starting to spread and contributed to the stock market sell-off. And the logic is pretty simple. If you can suddenly get a higher guaranteed return from a safe government bond, why take the risk on stocks unless it's going to give you a better return? Higher yields make stocks, especially these high-flying tech stocks, less attractive because you're not getting as much return for the same level of risk. And before the report, futures markets were pricing in a pretty good chance of a rate cut probably by September. But after the report, those odds pretty much went to near zero. The market was pretty much forced to accept a world where interest rates stay higher for a lot longer than anyone thought or really hoped for. So we've seen the data and the market's brutal reaction on Friday. Now for the most important question: why? Why does a report showing hundreds of thousands of people getting jobs make bond yields soar and stocks fall? The answer is the fundamental change that the Federal Reserve is facing. The Fed is juggling two commands from Congress. It has a dual mandate, and that is to keep prices stable and to get to maximum employment. And a lot of times, like right now, those two goals have been at war with each other. To fight the worst inflation in 40 years, the Fed had to slam on the brakes by raising interest rates. Higher rates make it more expensive for businesses to expand, for you to buy a house or a car. The goal is to slow the economy just enough to cool down demand and get inflation back to its 2% target. But as I talked about last week, there are also plenty of supply shocks that have happened since COVID that cannot be fixed by rate hikes or monetary policy, like what we're seeing with oil prices right now. A Fed cut or hike does not reopen the Strait of Hormuz. But regardless of it being a demand or a supply issue, the big risk is that hitting the brakes too hard could send the economy into a recession, costing millions of jobs. So, for the last few years, investors have been betting on and hoping for a soft landing. This idea that the job market would weaken just enough for inflation to fall, giving the Fed the green light to start cutting rates again. But the May jobs report completely changed that story. So, here's the chain reaction that went through a lot of traders' minds. First, a blowout jobs number plus steady expected wage growth means the economy isn't functionally slowing down. It could be running hot. And a hot economy means more people have jobs. They're getting paid more, in theory. Second, when people earn more, they spend more. All that spending can keep inflation high. Taking that last mile of the inflation fight, getting it from these high 3% all the way down to 2%, incredibly tough. Third, the Federal Reserve sees this, and for them, a job market this strong removes any urgency to cut rates. In fact, it might even do the opposite. It gives them a permission slip to keep rates higher for longer. Their number one job is to make sure inflation is controlled without sacrificing jobs and employment. So if the job market is booming, it tells them the economy may be able to handle high rates for a while longer without breaking. So this is the heart of the good news is bad news reaction. Good news for jobs is bad news for anyone hoping for lower interest rates. Bond traders, whose returns are directly connected to the Fed's next move, see this logic and they're acting pretty instantly. They're selling bonds, which send yields skyrocketing. The market has basically decided that the finish line for rate cuts just got moved way, way further into the distance than people thought. But there's also a wrinkle here that's really interesting. We have a new Fed chair on our hands in Kevin Warsh. He's been handpicked by President Trump to replace Jerome Powell as Fed chair, and Trump has made it very, very clear over many statements that he wants to see rates come down, even though he told Warsh to be, quote, totally independent at his swearing-in ceremony last month. All of these numbers and data points together make the likelihood of a rate cut almost indefensible, almost impossible, like we've talked about already. And Warsh knows that. But given the current situation he is walking into, I don't know, and I don't think anybody knows, if he will be willing to call for more hikes, even if that becomes the necessary, albeit very bitter medicine needed in the future. But we'll get a better idea when he has his first FOMC meeting as chair, which starts on the 16th. Now, I'm filling this on the 9th. The other thing to be aware of is that the next CPI print drops tomorrow morning, which everyone will be watching very closely to see if headline inflation comes in line with expectation. What's priced in right now is about a 0.5% rise. That's pretty significant, and it's based on increased energy prices. I honestly wouldn't be surprised if it comes in hotter than that, but if I had a crystal ball, I'd tell you. Sadly, I don't, so we won't know until the print comes out tomorrow. And even then, the reaction to one jobs report or one CPI print, and there will be a reaction, that's one thing. But what's also rattling investors is the idea that this wasn't a fluke. And it's feeding into a new and growing theory on Wall Street that the era of these low interest rates is over for good and it's not coming back like everybody wanted. And this gets into a debate over something that's called the neutral rate of interest, or R star. And I know that sounds like a very boring economics lesson, but just hang with me. The R star is kind of like the Goldilocks of interest rates. That's not too hot, not too cold. It's the rate that doesn't slow down economic growth, but it also doesn't stimulate it either. It's neutral. And many economists have tried to create variations of different models to figure out what this sweet spot is. And there's a lot of conflicting opinions and ideas about it. For years, everyone thought this rate was very low and would stay very low. It fell significantly since the Great Recession, and people have debated why and whether that is a good thing ad nauseum. So I don't really want to get into it in the weeds of all of that in this video. But the question now being posed, and the reason I even bring it up, is what does it mean now that the R star looks like it could be rising significantly? For much of the last few years, I think that Wall Street has functionally been treating these higher rates like almost like a surprise house guest who's been sleeping on your couch for a couple of weeks, and you're kind of eventually hoping that they'll just get the hint and move out. And in reality, they've moved in and you basically have a new roommate and they have no intention of going anywhere. And everyone just has a bunch of wishful thinking that's not based in reality. Like they're not going anywhere. What if big shifts in the economy, like government spending and a new tech like AI, mean that the baseline interest rate needed to keep things stable is just structurally higher now? If that's true, it means that the Fed can't and won't cut rates back to the near zero levels that we all got used to, because they won't be able to complete their dual mandate if they do. The May jobs report poured jet fuel on this idea. An economy that can create 172,000 jobs while interest rates are at a 2-decade high suggests some underlying resilience, more resilience than people thought. And this has prompted some major financial institutions to rethink their long-term forecasts, with more analysts pushing out their timelines for rate cuts, some indefinitely. And it may not necessarily be the consensus view, but the very fact that a higher for much longer scenario is being seriously discussed is a huge shift from where we were even a few months ago. And this has big implications. For the stock market, it's a constant headwind for the growth and tech companies that have led and outperformed for so long. Large cap tech has been the trade. That may no longer be the case. Now, that being said, we've kind of expected there might be a turnover into small cap, but small cap typically doesn't do as well in higher rate environments. For the bond market, it means more potential pain for existing bondholders. But on the bright side, there's also a chance for new investors to lock in the best yields we've seen in a generation. We are watching a fundamental repricing of the cost of money. And this single jobs report was a huge catalyst for keeping that price higher and a defense for staying away from rate cuts for a lot longer than a lot of people hoped for. So we've talked about bond yields and R stars and Fed policy, but what does this actually mean for your personal finances? The shockwaves from this report will be felt on Main Street, not just Wall Street, just like anything like this will affect everyday people. And we're going to start with the biggest expense for most people, which I've pointed out a few other times recently: housing. The 10-year Treasury yield is a strong benchmark for mortgage rates. So when it jumps, mortgage rates almost always follow. And the market's reaction to the May jobs report kind of slams the door, unfortunately, on anyone hoping for 5% or below sub 5 mortgage rates returning anytime soon. Now, for anyone trying to buy a home, affordability will once again remain a pretty big hurdle. And this higher for longer world hits other kinds of debt too. The rates on credit cards are often tied to the Fed's policy rate. So with the Fed on hold, there will be no relief from those record high credit card APRs that I've talked about before that I would really like to see people stay away from. And the same goes for car loans and personal loans. The cost of financing big purchases just isn't coming down, and there's no sign that it's going to come down anytime soon unless something major changes. And finally, your 401k, your Roth, your other investment accounts. This reaction is a big reminder that the investments that have worked for the last decade aren't guaranteed to lead forever. A world of higher interest rates can cause major shifts under the surface. And these high flying tech stocks, like I said, they're so sensitive to rates and may face more pressure, while other sectors that have kind of been ignored, like stable, value oriented companies that produce strong cash flow now, people are going to start looking at those as maybe more appealing. And this doesn't mean you should panic and sell everything. Again, I do not give investment advice on here. It just highlights the importance of how we think about diversification and knowing that different economic environments favor different kinds of investments. Overall, the market isn't just reacting to one jobs report. It's reacting to the possibility that, and what's looking to be likely the new reality, is that the last 15 plus years were the exception in terms of borrowing and money flow, not the new rule. And here's the bottom line. The May jobs report came in shockingly strong, showing a labor market that is still firing on all cylinders. But some of the underlying numbers mean that the engine may not be as strong as it looks on the surface. The market saw this good news as bad news in terms of asset pricing for one simple reason. It gives the Fed the justification it needs to keep interest rates higher, to keep fighting this war on inflation and getting it back to their target 2% inflation rate without sacrificing a healthy labor market. Now, if businesses can keep posting strong earnings and expand at a healthy rate and withstand high borrowing costs, the case for higher rates will get a lot more defensible in these Fed discussions. Unfortunately, though, I think we are seeing some pretty short-sighted, almost ostrich-like behavior from a lot of Wall Street and from a lot of analysts, because in a consumer-driven economy where consumer spending accounts for roughly 70% of GDP, we cannot keep ignoring how households are feeling the squeeze, both in terms of lower purchasing power, coupled with overall wage growth not keeping up with inflation. And that's the disconnect right now between Wall Street and Main Street. And that's nothing new. And the medicine to fix it likely isn't going to be fun to take for anybody. But there is a major difference in the tenor of how you're hearing traders, a lot of investors, many economists talk about some of these statistics, some of these numbers coming out. And on one hand, there's a major case for a strong labor market and an overall strong economy. But the anecdotal conversations that people are having every day, the questions that I'm fielding, the feelings people have about being stressed, even some people are using the phrase a vibe session. We're not in a recession, but the vibes, the feelings, consumer sentiment, Main Street sentiment is not matching with what we're seeing in the markets right now. So what should you watch out for now? The next big test will be what I mentioned earlier, which is tomorrow's Consumer Price Index or CPI report. If it shows a big surprise drop in inflation, it could calm the market's nerves, which right now is not doing so hot. Another hot inflation print would only confirm the higher for longer fears. And beyond that, all eyes are going to be on the Fed. So with that, we're ending, as we always do, with a biblical frame. We're moving from the discussion of economic realities and what that practically means for you, and moving into how people who know and follow and love Jesus should relate to this reality. And I say it nearly every video, and I might say it every time, who knows, but it does bear repeating. Your hope, your worth, your security is not in money, and it is not in the here and now. It is in the person and work and promise of Jesus. But for this topic in particular, what I keep coming back to and what I have to remind myself as much as anyone else is to remember the very unique situation we find ourselves in this information age. And specifically, how much real-time, constant, immediate information we have right at our fingertips. For better or worse, I can pick up my phone or even look at my watch right now and get a real-time look at what any market that is open across the world is doing. The BLS report was published Friday morning. I was reading it within minutes. And this interconnectedness gives me unlimited resources, basically unlimited resources to prepare these videos, to learn and study markets and economics and finances. And all of that can be really helpful. It helps me do my job better. But to pull it back to a more macro level, I have found myself picking up my phone constantly the last few weeks to see what markets are doing, to see if any new information has been published about the peace talks with Iran, to look at oil futures prices. And then, because my algorithm is two things, finance and cute dogs, I go doom scrolling for 30 minutes of golden retrievers being silly to try to comfort myself. Why do I bring this up? Two reasons. Number one, there is a lot to be thankful for in having this level of information and news available at our fingertips. I don't want to be like a spiritual Eeyore and constantly just gripe about the challenges of our worlds and the moment that we live in. The ability for me in Austin, Texas, to be able to track market and global economic activity from the comfort of my living room in real time is incredible. I have the privilege of a better understanding of our global landscape than most generations would have dreamed of. That is not a commentary on me. That's a commentary of just the worlds that I have grown up in. It allows me to do my job better. It allows me to learn more about how God has designed everything in the world, including order and logic and math. And all of it helps me better understand and love his character even more. And there is wisdom in moderation. There is wisdom in setting it down. And I have to tell myself and remind myself more than anyone, why am I constantly checking? Why do I feel the need to know minute by minute what the market is doing? There's a lot that's defensible about it. There's a lot that, as a follower of Jesus, there's absolutely nothing wrong with keeping tabs on these sorts of things. And for me, when it's part of my job, when it's part of what people quite literally pay me to do, I need to do that with excellence. But I say all of that to say there is a line. And there is a line that I have to be careful not to cross of I am looking at these things, I am paying attention to these things, I am researching these things so that I can be better at my job, so that I can post a helpful educational video that I find interesting and that I hope others find interesting and helpful as well. But if it veers into I'm doing this because I'm nervous. I'm doing this because I think if I have all of the information, I can somehow control the outcome. And to be fair, there's plenty within my stewardship, within my financial choices, within my work that I am called to and handed to control. But in terms of when I'm saying the macro, eternal, where's my hope? Where is my joy? Am I looking at and constantly getting information because I want to do my job well for the glory of God? Or am I doing it because I know I'm trying to grasp at straws to make myself feel like I'm the one in control and I'm the one sitting on the throne? I'm not. He is God. I am not. And if any of that resonates with you, if you find yourself in a similar situation to that as me, what I do, and I always share these things just as helpful tools. What I do is ask myself a few questions. And the first one, it's really easy to ask. A lot of times it's hard to answer. But the first one is, where's your heart? Where's your heart in picking up your phone? Where's your heart in looking at Bloomberg again? Where is your heart in reviewing these statistics and looking at the news? If it is a heart of excellence for the glory of God, praise the Lord that He's given you that heart, because that is Him, not you. But if your heart, is in a place of sinful fear or pride or fill in the blank, get on your knees, open His word, and figure out what it looks like to trust Him and not trust information or numbers or what you can do with said information or said numbers. That would be the first question. And the second question is just the really practical, do I need to take a break here? And some of that, depending on, like me, if it's your job during the week, again, it's what I'm paid for. It's probably not wise on a trading day to take a break from doing my job. But on a weekend, Do I really need to be reading the BLS report? Probably not. On a weekend, do I really need to be picking up my phone to look at oil futures prices or every few minutes looking to see if something has happened in Iran? No. So, do you need a break? Do you need a detox? Not for the sake of patting yourself on the back, not for the sake of making yourself feel better about it, but for the sake of saying, anytime I want to pick up my phone, basically fasting. I'm not going to pick up my phone. I'm going to pick up my Bible. And I'm going to trust in the Lord, even in uncertainty, even in an information age where I have more information at my fingertips than I could ever possibly consume. I want Jesus more than I want information about the world. That's where we land today. There were a few times, I don't know if you could hear it, there were a few times my dogs were barking in the background. So if that comes through in the audio, my apologies. And I will see you guys next week.